In fact, salaried people are the ones who are easily tracked by income tax department, and it is easy for income tax department to catch them or account them or discover if they are avoiding tax. So that's why we always say that, okay, salaried people are those who pay more tax. But then businesses actually pay tax, even the self-employed people pay taxes. But then there are many ways to avoid paying taxes. But then for salaried people, government has created various provisions to save tax. It is just that people are not aware of it. In today's video, I will tell you how to save maximum tax if you are a salaried person. It is very easy. When it comes to saving taxes, if you just pay attention to it and if you are conscious throughout the year, if you plan for tax saving on 31st of March or during the year end, you will not be able to save tax. Tax saving consciousness should be practiced from the day one of the financial year. So primarily you can do 5 things when it comes to tax saving. Number 1, you will have to discuss with your employer and ask them to structure your salary in a tax friendly manner. When I say this, you can actually ask your employer to provide you all possible exempted allowances, be it food coupon, travel reimbursements, telephone reimbursements, reimbursement for research and publications or books and periodicals, leave travel allowance, medical reimbursements, HRA, all possible reimbursements and all possible allowances can be captured or can be divided or classified in your pay slip and your offer letter. When they do this, it will be very easy for you to claim all these benefits from the income tax department. So this is something very important you will have to take care. So restructuring your salary. Number 2 you will have to take care is, you have to consider all possible deductions available, exemptions available under Income Tax Act. Under Section 80C up to 1.5 lakh. Under Section 80D for your health insurance for yourself and your parents, put together about 50,000 change. For National Pension Scheme, whatever you invest, that is extra 50,000 is allowed. Then you have donations made under Section 80G. Then you have home loan interest under Section 24. If you have got any education loan interest under Section 80E, like this, all possible deductions should be taken care. This is number 2. This is very, very critical. Number 3, if you have higher income, if you're somebody who is earning probably upwards of 5,000, you should have a decent chartered accountant to guide you. Though it is very simple, it's good to have someone to take care of your finances, especially your taxation part. So he'll be able to continuously update you. If not, have someone like Indian Money to guide you. Or you can actually do self-study. You should learn. So you should have a mentor, or you should be able to learn on your own. You should have a guide like a chartered accountant, or you should have someone like Indian Money to guide you. If not, you should be able to do self-study. This is third thing, very important, because we think, okay, hey, let me take care of it on July 31st. Then you will fail. Number 4, and the most important thing about taxes is, you will have to ensure that you file your IT returns on time. When you file your IT returns on time, you will be able to claim your excess tax paid. You can claim the refund of excess taxes paid. Otherwise, you'll lose it. That's a big loss for you. So why do you want to lose so much? So please file your IT returns on time so that you can get excess taxes paid on, the refund of excess taxes paid. And number 5, look for additional opportunities to save tax. For example, you have already got a one home loan running. You have also got your other ATC, ATD, 24A, section 24 or ATE, everything is covered. Now you have another opportunity to save some more tax. Instead of investing in ELSS schemes or investing in mutual funds, any other mutual funds or tax saving FD, you can actually go for a second home. When you go for a second home, up to 2 lakh rupee loss incurred from the second home can be covered every year under, from your salary income. Which means, let's say you buy a second home worth, let's say 50 lakh. You have taken 40 lakh rupee home loan. Now what happens? You will end up with paying 40 lakh rupee, means at least about 3.5 lakh rupee interest every year. Since you are paying 3.5 lakh rupee interest yearly, let's say you have rented out your property. From that you get 2 lakh rupee rental income every year. Now 1/3 of that will go for maintenance. So 2/3 is taxable income. Now this 2/3 can be deducted from the 3.5 lakh rupee interest you are paying. So now what happens? You have got about 1,33,000 will be taken out. Now how much are you still left with? About 2,16,000. Out of this, 2 lakh is exempted straight away because you are paying interest on that home loan, which will save, if you are into 30% slab, 60,000 rupee more tax. It's a good idea. You can actually do that. So like this, and on top of it, you're creating another property, right? So if you want to save more taxes, there are plenty of opportunities. IndianMoney.com is always there to guide you. All you need to do is just leave a missed call on IndianMoney.com financial education helpline number 02261816111. We will call you back, help you save maximum tax. If you also need any guidance on any other financial product, just leave a missed call or visit IndianMoney.com website or download Indian Money mobile application from Google Play Store. We will call you back, help you make wise financial decisions. Thanks for watching. Be wise, get rich.